of putting this together was before lockdown, and we looked at how can we put a network together that we could influence to do with our mission, to do with our 12 Ronnie's mission, which is the parent company, which is all about helping startups launch successfully. And that's what we've been exploring, both in terms of tools, but also services and mentorship that we can provide for these people that are about to launch a business, or thinking of launching a business, or have ideas that might be suitable for launching a business. And the network itself has now built to, I don't know, Chris, the last time I saw it was about 850 members. So
yeah, roughly about, yeah.
We're moving on towards the 1,000 mark, and it's fairly evenly split when I've been looking at it between founders and mentors. There's probably more mentors than founders, but that might be because I've been focusing on the recruitment. Everybody's been invited on here, and I've been focusing very much on mentors and people within my LinkedIn network to get them on as sort of mentors. I think the founders side will be quite easy to get up and running, particularly once we start to do more mentoring and collect more data. But where we are at the moment with the actual platform is we've now got enough people on here that we can start facilitating mentoring. Currently, it's been very much have a look at somebody's profile, see if you want to talk to them. If you're a founder, seek out a mentor and have a chat with them and see what you can progress in a fairly unstructured way. We're now moving to slightly more structured mentoring, and what I mean by that is we've put together a mentor matching tool, so founders can now use this tool to search for mentors with particular skill sets or particular industry sectors, should I say. And we're also putting together a number of other initiatives to match founders with mentors. And one of them, and I can see Daryl is on the call here. This is a brilliant brainchild from Daryl. Is we're going to be running at the end of this month a pitching contest, and most pitching contests it's normally founders pitching to investors. It's normally them looking for money, and it's quite a hard sell and it's quite stressful. What we're putting together is a pitching contest. But this time it's pitching your idea to a group of mentors. And so this isn't about having to do a really hard pitch. This is just explaining your idea, where you are with it and what you need help from. And then we're going to have these pitches submitted via 90-second videos, and the mentors in a live event will discuss the pitches and see where they can help. And it's a much more friendly environment to a pitch, rather than, you know, the hard sell of founder investment pitches. So that's another way we're looking at doing mentor matching. We're also going to be launching next month the Mentors Community, which will include mentors being given a handbook and some guidance on the way that we see 12 Ronnies helping this ecosystem, and some of the guidelines that we think will be really helpful for mentors. And within that community, we'll then be matching mentors that have been through this program, if you like, with some of the founders. So it starts to get more and more structured. But what's quite important for us is that we don't just follow structured routes. We're really happy for any founder or any mentor to contact each other, to talk, to see if they can help each other. So the platform also, you'll see the next time you log on, or you should have seen today, there's been a rearranging of content. So we've got new welcome messages, other posts have been put into featured and into discovery parts. We're launching a new help section. So there's quite a lot happening now on the platform, getting really ready for us being a bit more serious about structuring the mentoring and getting people together. But I want to sort of lead into this talk today, really, from Richard, because one of the, and it comes up time and time again, that and I've said this, you probably heard me say this 1,000 times, but if you ask any founder, any pre-launch founder, or any entrepreneur really, what's your biggest struggle? What's your biggest problem? What do you want the most? It's almost certainly investment funding. It's almost the first thing everybody asks for. Please, can I have somebody else's money to help me build my business? You know, and we've taken the approach here at 12 Ronnies, at Founders and Mentors, that you're probably best off, you're almost certainly best off having an idea customer fit. You know, if you don't have that, if you don't know what your customer looks like, if you don't know what they will buy and what they're interested in, how much they're going to prepare to pay for it, then asking somebody for their money is, I don't think is really particularly fair, because you don't know who your customer is. And I'll be interested to hear what Richard says about founders that don't have an idea customer fit, but also tick other boxes. So that's, for me, this is quite an interesting talk, if you like, because the investability part is on everybody's mind. And we're saying at Founders and Mentors, hold off till you get an idea customer fit. But I'd be quite interested to hear Richard's angle on all of this.
Richard, over to you, and please share your screen with the details.
Very good. Thank you very much. And host has disabled participant screen sharing, apparently, Chris. So might need to fix that before I can share my screen.
Have I not? Ah, I thought I'd made you the host. I'll reclaim the host again, and I'll make you the host again. Okay, you should be the host now.
Let's try again. There we go. Well, good afternoon, everybody, and those here already and those still to come, no doubt. We'll see how we go on numbers, because I suspect that if we've got a group of 8 or 9, we're going to be better off going for something a little bit more conversational than the kind of more formal presentation that I had planned. But let's see how we go. And let me kick off by answering partly what Simon was asking before, which is, when we look at the whole investment process, when is the right time to fund? Basically, the answer to that is as late as you possibly can do. Funding is something which takes about a quarter of the lifetime of founders. So if you think about a founder of a business that's dependent upon independent external funding, probably needing to fundraise once every 18 months or so, and probably for a good few months before they actually achieve funding, spending their entire lives doing that only. The idea that you can waste a quarter of your life doing this is pretty scary. You can't always avoid it, so we're going to talk a little bit about how to try and make the judgment around when to start, but also how to make the process as efficient as possible once you've decided that you have to go through it. Now, having said that, there's a whole group of people out there spending a quarter of their time on fundraising. We're the idiots that spend 100% of our time on fundraising, because that is our job. So Capital Pilot is a business which is a rating agency, and we rate early stage businesses based on their investability, based on the quality of their investor proposition. And this is a really major issue, because for every investment dependent startup, access to funding is critical. And as we've said, it's a time inefficient, resource intensive and cliquey environment that you have to navigate to try and get a decent response out of it. And there's massive pent up demand for funding in the marketplace, especially right now. And we would say the fundraising industry is utterly unfit for purpose when it comes to fulfilling the needs of the growth businesses. And that is largely because it is a cliquey, resource intensive and inefficient system. And we have as a bit of our mission trying to change some of that to bring efficiency and scale into that process. And we do that through data. It's about bringing numeracy into the subjectivity that currently is the key driver of investment decisioning. So rather than this whole thing about, oh, well, I need to go and have a drink down the pub with the potential investee to see what sort of a person they are in order that I can make my investment decision. No, what are the things that you're actually trying to capture in that conversation? And how do we score them? How do we turn that into numbers rather than impressions? Capturing that data enables us then to correlate with outcomes, and we can then start to figure out what sorts of businesses get the best outcomes and improve the entire system throughout that. It's about standardization of decisioning, it's about bringing efficiency into the process, and it's about improving outcomes ultimately for founders and investors, because for both sides, this is a highly inefficient process. And we do that through a rating process. We're Equifax for startups, if you like. We have a process which tells you your credit score, or in our case, your investability score, gives you a guide as to how you can improve your score, and then, if you wish, as a founder, communicate that score to the investment marketplace, only if you wish, so that you can use it as a signal of your quality in a market which is highly biased towards certain investor types from certain regions. So the whole process here is about trying to put numbers on investability. We have 4 categories in our investment rating: the quality of the market, the quality of the business opportunity, scalability of the model, and of course executability, which is all about team. And we put numbers on each of those things and come up with an overall rating, which is the way in which we are able to signal to investee and investor how they can best find each other and do the best possible deals. So as we then move on, obviously it's sort of pretty well known that I borrowed this chart from somebody else, right? I didn't do this one myself because there are thousands. If you go and Google startup journey, you'll get thousands of these charts. Go back to Simon's question before we kicked off. Where is the point at which you should be thinking about raising funds? And here is a chart which shows formation, ideation on the left-hand side, all the way through scale up on the right-hand side, taking the idea to business, taking ideation to established business via the various different elements. And the way it's described here, problem solution fit, which is really the founder ideating the business and then communicating that with the team, then starting to evolve into the process of checking how that fits with the marketplace that they've chosen to address. And then at that point, the validation post creation of minimal viable product from then on. And effectively somewhere between 0 and 2 is the time at which we would say you can start to get funding. If you're at 0, it's probably your mates or your parents. If it's at 2, theoretically, hopefully, you've got the ability to raise money from third parties that you don't know. Very different processes, taking money off your mates and taking money off third-party investors. Very different processes, and we will talk a little bit about how that whole process runs through. And obviously, deciding when the right time to fundraise is based on a judgment as when the risk reward from the investor's perspective is balancing out. So the reward side in an investor proposition tends to be to the fore. The risk mitigation element of an investor proposition tends to be ignored by many founders, and that's a significant source of weakness in many companies and many founders' investor propositions. So making sure that you're focusing on the risk as well as focusing on the reward elements is vital. So let's just move on. Chris, just to check, are you following the waiting room and are you able to admit people? Because I'm seeing it pop on mine.
We'll just unmute myself for a minute. I propose that we carry on as you are, and then because it seems to be a problem with Eventbrite this afternoon, because I've got 3 emails going out to people which they should have received with the joining instructions. what I propose we do is make this recording available immediately afterwards to everybody that books up for the session, and make sure that we have your contact details as part of that email, so that nobody feels shortchanged, and we can explain that it was a technical problem with Eventbrite.
That's absolutely fine. I've just got people in the waiting room apparently who.
Oh, do you? Okay. Oh, right. Okay. Well, why don't I
can see because I'm currently the host.
Oh, okay. Well, why don't I? Okay, I don't see those, so you can either admit them. I guess.
Yeah, I didn't get a invite by email, but I see that it's just been posted on.
Yeah, no, I posted it 3 times, and none of them seem to have gone through. And I also posted to everybody who's a member of Founders and Mentors, and that one hasn't gone through either. So that was like 4 hours ago. So you know,
I've just got Simon's message now. So and I clicked on that link, and I'm in. So now on.
Okay. Yeah. So can you? I mean, maybe what I will do is reclaim the hosting for a minute.
You should be able to have a host and a co-host, so you can make one of you the host and one of you the co-host, and then you can both kind of share.
Okay.
Share stuff.
Right.
Well, I'll continue.
That doesn't seem to be. Yeah, just keep going, Richard. I mean, it's you know, we just have to live with the problem we've got, I think, and then I'll make you the host again.
Richard.
Yes.
Richard, I think if anybody's there and you see in the room, just admit them and just carry on with the talk, I think
that's what I'm doing. I just
brilliant.
Okay, very good.
Okay. Yeah, thank you. Apologies for the intermission.
Very good. Okay.
Thanks for your time to get a cup of tea.
Everybody's got their ice creams and their fresh cups of coffee.
Exactly.
So here we go. So we're talking about risk and reward and the need to balance risk and reward, and the fact that often the founders focus more on the reward elements than on the risk. And if we then move on to talk about what it is that investors are actually looking for, black here on the right-hand side in the bullets denotes reward and red denotes risk or risk mitigation. So really what investors are looking for is an attractive market, differentiation, traction, very, very important, and probably one of the key determinants of when you should start fundraising. And then on the risk mitigation side, we're looking at the credibility of the ambition of the team, so the appropriateness of the forecast that they're putting forward, appropriateness of expertise, so is this a team that's got the right expertise around it, accuracy and precision in the way in which the proposition is put together, which suggests that your team is a group of people that know what they're doing, clear thinking, groundedness, behavioral fit. You can see we're sort of trending more and more from the objective to the subjective. And this is one of the key issues about the current system, which is so subjective, because ultimately we're looking at behavioral fit and whether or not a team is credible as being very significant drivers of that risk mitigation decision. And obviously, when we talk about how you're communicating with investors, we have to deal with the fact that we're transmitting and receiving information, often in different languages. And we have that issue as we go to the co-op each day and ask for our groceries through a mask, hopefully not with these outcomes, but with others. But in the investment world, one of the things that we're seeing quite frequently is the fact that you have founders talking their story rather than communicating in the language of the investor. So are you, as a founder, able to tell your story in terms that the investor recognizes suiting their requirements, or are you simply fulfilling your own desire to tell the investor how brilliant you are? If so, in the latter case, you're probably not on the right track. So as we start to move forward then, as we plan our fundraise, where are you on your startup journey on that timeline that we showed before? Whereabouts are you? Have you gotten to that point of inflection somewhere between 0 and 2? Questions here. Stop and think. Is external funding the right answer? It's not clever. It's not the smart thing to do to raise money, to waste all that time and to put your business at risk by not focusing on core operations. What form of funding is the best fit? Maybe it's not equity, maybe it's debt, maybe it's grants. It could be a whole range of different things other than equity. And obviously, do you actually want to have external shareholders? Is that right for your business? Is that right for the makeup of your team going forward? And obviously at the end, and the key thing that we'll now spend a bit more time thinking about, is your proposition sufficiently good to excite investors? Or are you really not going to be spending your time effectively or efficiently? So let's think, as we go through this checklist, initially about the marketplace. And within the marketplace that you as a founder are targeting, we're asking initially here, is your target market sufficiently defined? Are you able to say it's this sort of a customer in this particular subsector that I'm going to be going after initially? And then after that, I may be moving into different subsectors, but being very clear about what your target market is a very important thing. All enterprises with more revenue than £200 million per year is not a great start. So we're looking at medium-sized businesses based in the northwest of England who have more than 250 employees. Then you start to be able to figure out more effectively and describe more effectively what your core market is. And secondly, in terms of target market, you need to be able to demonstrate that that target market is big enough for you to build a business that's relevant to your investor, because your investor wants to see a return, and that return is going to be driven through growth. And if you can't grow your business because your market isn't big enough, then you're not going to be of interest to your investor. So again, think of it from the investor's perspective. Market need. Is there a compelling need in the marketplace for your product or service, or is it a nice to have? Is it yet another restaurant booking app? Apologies to any restaurant booking apps on the phone today, but is it yet another way to do something which is effectively already achievable now, or is this a must-have for that market? Key thing. And if it isn't a must-have, if you haven't been able to prove through your investigations of your market that there is a crying need for what you're trying to do, then that's a problem. It's one of the things that we struggle with as a business. Does every startup want to have a rating? No, a rating in itself is not the thing that a startup wants. There's no compelling desire to have that thing, a rating. It's what the rating enables the startup to achieve that we're trying to sell, which makes the sale a little more complex in our case. Differentiation, similar to market need. Is what you're doing sufficiently different from whatever else is going on in the marketplace? And then finally, do you know what everybody else in the marketplace is doing? Because if you do that classic of saying, I don't have any competitors, what I'm doing is unique, again, you're going to rub up fairly quickly against failure, because most things aren't unique. And most ideas that you may have had to build your business will have in some way or another been put together by somebody else. So what is unique about your business? What is different about your approach, which makes your proposition sustainable and likely to grow? So moving on then from marketplace, we'll talk for a second about business model. So this is what you're doing within your marketplace. Market approach. What's the evidence that the way you intend to sell into your market is likely to be successful? Is it a process or a methodology that others have used? Have you tried it out yourself already? This is back to traction. Are you able to describe the fact that you have tried this out, it has been successful, and you're able to demonstrate the outcomes from your approach? We talked a few minutes ago about the importance of being able to describe traction and momentum. Absolutely vital, whatever stage you're at. If you're only an idea, you hopefully will have shared your idea with other people who think it's a good one. That's traction. If you are a company that's looking to raise £10 million, then traction is called revenue. You need to have got some revenue, probably, in most cases, by the time you're trying to raise that amount of money. So traction is relative to stage, but whatever stage you're at as a business, if you can't demonstrate traction that is the bare minimum for the stage that you're at, then again, you're unlikely to be of interest to a potential investor. Scalability. Scalability is about two things. Scalability is not only about, is the business model that you have able to be scaled in an efficient manner so that your profits growth is going to outstrip your revenue growth, but also, have you got a decent plan for how you're going to achieve that? The number of times we see plans of businesses where they still have 3.5 people working on the business in 5 years' time in their financial forecasts when they're turning over 100 million quid, it doesn't bear thinking about. So we need to be able to demonstrate scalability and the fact that we have a clear plan to build the business in a cohesive and credible way. And then deliverability. I mean, in some cases, there are regulatory hurdles, there are competition hurdles, there are distribution hurdles, production hurdles, which are going to make it difficult to get your product to market. So you may well want to be selling 100,000 widgets in 2 years' time, but there may well be a major structural hurdle along the way, which needs to be identified and mitigated. And again, that's on the risk mitigation side from the investor, as we talked about at the beginning, but very important in terms of defining precisely where your investor proposition is going. And then finally, on the execution side, there are various different elements of this. And again, we're kind of drifting back into the subjective as opposed to the objective. Is it obvious why you are the best possible team to make your business succeed? So again, we see this many times, teams with ideas, and you think, well, actually, there are probably people who are much better suited, businesses that are much better suited to pursue this idea than this particular one. And that will always be a problem. Relevant experience, not absolutely vital, because you can have a 22-year-old founder who's straight out of school or university, who's got all the drive and all the entrepreneurial wherewithal to make a great success of their business. But quite often, the requirement for a good blend of startup experience, sales skills, technical expertise, and risk management is what will float the investor's boat. Business planning, for financial forecasting, I'm thinking here strategic financial forecasting, the ability to put together a good financial model, which is credible, which demonstrates in a logical manner how you're going to build your business. A good signal, actually one of the most powerful signals, I think, to a business's investment readiness is their ability to talk in a logical and numerate manner about how they're going to scale. And then again, just to repeat this one because it's so important, can you actually define what your investor proposition is rather than your market proposition? Can you explain to an investor in their language, in their terms, how they are going to make money out of investing in your business or achieve their outcomes to the extent that it's not a fully commercial business, but it's an impact-driven business? So all of these elements are the checklist for defining how ready you may be to go to market and raise funding if you've chosen that that is the thing that you must do. Now, we've just run a big campaign over the last couple of months to deliver a whole load of ratings and assessments to a couple of hundred companies across the UK so that we can capture lots of data about where companies are going well and where companies are going badly. And obviously part of our ongoing sales campaign to build our own business. But a couple of slides here about where startups typically do well and where startups typically do badly within our rating. So as you can see on this chart, these are the things that startups are typically good at according to our rating system. The definition of a market need for what the company is looking to build, that tends to be done very well. The quality of the design and branding of a proposition, the presentation, most presentations that we see are really well put together and there's a decent design to the presentation. Not the most important thing, but first impressions are kind of important. The description, the clarity of the problem and solution description, again, quite a strong point. And the definition of the target market size and growth potential, again, tends to be done quite well in the companies that we assess, in the couple of hundred companies that we assessed over the last couple of months. So this is really thinking from the founder's perspective, what are probably the things that are closest to their hearts as they think about their business. The nature of their product, the need for their product, and the market into which they're selling it. Less positive, One that stands out at the top is startup experience. So this will tell whether or not we think it should tell. It will tell when a startup doesn't have, or the founder team doesn't have, significant prior experience. Key thing if you're trying to raise money from a third party that you don't currently know, who can't validate your prior experience, whatever that may be. So the need to build into your proposition somehow some startup experience through an advisor, through a mentor, through a consultant, through a board member. Very important, and something that isn't done often enough, as you can see. I banged on about the financial model. It is a bugbear of mine, but the number of poor quality financial models that we see is a significant problem and a significant cause of reduced ratings. We're actually looking to try and solve that problem through automating the production of financial models in a piece of R&D work that we're working on at the moment. The quality of the presentation of traction, again, we've highlighted it earlier on, really, really important. Whether or not the company actually has good traction or momentum, the way in which it's typically presented in the investor presentation is poor on average, and again, a source of significant negative ratings in the businesses that we see. And the great thing is, actually, that's an easy one to fix. The financial model is a pretty easy one to fix. The startup experience is relatively easy to fix, and the articulation of the investor proposition is equally fixable. So what this is really saying is, many of the companies that decide they're ready to go to market, in fact, aren't. And the reason they're not is fixable. So these are some of the key elements that we have identified through our research and through our work, through the ratings that we've done over the last couple of months, as being areas which are particularly needful of additional care and attention as the founders are looking at their go-to-market strategy for investment. And this is all part of realizing that fundraising is a sales process like any other, where your customer is the investor, and where you're looking to identify the investor need. What is it that the investor is looking to achieve? What is it that, how good is your fit with that potential investor? So all of these various different segments about working smart, about building a proper pipeline of opportunities, about validating your pipeline, about planning a proper process and running it through in the same ways that you run any sales process, are as valid in investment as they are anywhere else. One of my other favorites is to talk about sales versus marketing. They tend to get lumped together. Sales and marketing is, I was going to say 2 words, it's actually 3 words, of course, but they tend to be talked about as 1 word. And the idea here that marketing is about how you describe your story and communicate your messaging generally to the marketplace that you're looking to target. Sales is getting people to do stuff. And they're very different things, but both need to be included in a fundraising process, the marketing element and the sales element. And this all requires preparation. So another answer to when are you ready to fundraise is when you are prepared to start a fundraising process, because you've looked at these various different elements on this chart to ensure that you've got a proper process planned, which is fit for purpose. Ultimately, the right time to seek investment is obviously investor-driven, not founder-driven. It's the point at which your story is right for investors to accept and receive and respond positively to it. And a cheeky sales message at the end of it all, how would you know when that time's arrived? Well, obviously and clearly by getting a Capital Pilot Investability rating. And so that's our way of achieving this, of our way of making sure that founders have confidence that they are actually ready for market, because they've got a score from a neutral third party in a standardized process, rather than a friendly nudge from a mate that says, yeah, that looks pretty good, or that doesn't look very good, or whatever else it may be. So that's really the core of what I had to say. We do have obviously some time for Q&A, which is great. And contact details here on the slide. Lots of resource on our website at capitalpilot.com to help figure out different aspects of investability and help prepare for fundraising campaigns, and then access to our suite of services, which currently is the investability rating and the 24-page report that comes along with that rating to identify and highlight those areas where improvements can be made. And then we also have an investor intro business, and we are building a fund which is about investing automatically as a result of our rating in businesses that achieve a certain minimum rating threshold. So if you score more than X in your rating, you automatically qualify for investment. We think that's the best thing that we can do to break the back of this inefficiency and resource intensivity in the investor marketplace. And that's work in progress. Fingers crossed, more news on that by the end of this year. So that's all I had to say formally. Very grateful to Chris and to Simon for inviting me along this afternoon, and to the rest of you for figuring out a way to join the call. Back over to you, Chris and Simon, and maybe we can do a few Q&As.
I'm just unmuting myself. Right, I'm back in charge, I think. Yes. Thank you very much, Richard. That was very interesting and informative. What I'm going to do now, especially as some people are literally just joining because of our technical issues this afternoon, is to ask Simon to spend a few minutes in response to put a kind of founders and mentors wrapping around what's about what Richard has said. And then in a few minutes' time, that hopefully that will give people who have heard what Richard had to say to put your questions into the chat so that we can ask them on your behalf. Also, just for people just arriving, we will be sharing this video very soon after it's finished, so that you know, don't worry, you haven't missed anything, only in terms of knowing what questions you might want to ask Richard. So Simon, can you take over for a few minutes and just respond? So, yeah.
Richard, brilliant. It's actually opened up so many questions for me. I've put a load of questions in the chat anyway, but the one that really stood out to me is the problems are fixable. So that slide that you talked about of what was listed as the real problems of why the investors weren't interested are fixable problems, and I think that's particularly interesting for me, because we've got a mentorship platform, and if our mentors can be guided on the sorts of problems that investors see, because you know the founders will still want investment at whatever stage, and if they can understand, if the mentors can understand what the problems investors see, they can head this off pretty early on in the process. So that's really interesting to know that these are fixable problems, and you know I think that's something that we can focus on a little bit more. I have a ton of questions, but I think I'll sort of let other people answer the questions. I just one of the ones I wanted to get the bottom of. I always talk about idea customer fit, and I've seen on the chat there's sort of a bit of debate about because you mentioned idea market fit. Do you see it in a different way, and how do you see it different? And do you see there's a ranking of importance, because that's sort of quite important, or that's quite relevant to what we've been talking about at Founders and Mentors?
I think it's a great question, and I think that yes, obviously that on the chat there are a few different ways of asking that same question. It's largely, I think, a question of terminology. So we're talking about the same thing.
Okay.
Because if you've tightly defined your market, then that's obviously a collection of customers.
Yeah.
So you won't be able to tightly define your market unless you've got a really good understanding of what the people or organizations within that market actually want. So they do actually come together. So yes, it's probably a good correction to say we're talking about customer fit, because really we're trying to make sure that what we're doing is acceptable and worthy of being acquired by specific individuals or organizations. That's what's going to generate revenue. So it's perhaps a slightly lazy way on my side of describing it as a market element rather than a customer element.
No, not at all. It was just, you know, I've always heard before started talking about idea customer fit as idea market fit. So I was just sort of, that's a really good clarification. And then the last part of that, and then I'll try not to hog this Q&A, is, does that all fall within the traction remit? So the idea customer, idea market fit, if you can validate this and show data on that, is that showing traction for the idea?
Yes, it is. And there's a question from, actually from you, Simon, as it turned out.
That's why I said it.
Which was talking about, you know, pre-orders. Is that a good indication of traction? Yeah. Yes, many things are a good indication of traction. So it could be a testimonial. It might be a letter from somebody saying, once you've built this thing, I will probably want to buy it. It could be very broad. And as I said, the ultimate expression of traction is revenue. Yeah. So whether that's a pre-order, an order, a sale, all the way back to an expression of interest from relevant people, all of that just depends on the stage, and it depends also clearly on the type of industry that you're in. So if you are coming up with a new branded consumable, for example, that could be quite a different type of traction that you need to express than if you're developing a new pharmaceutical product. Yeah. And in both those cases, obviously, you have two potential customers, the end user and the intermediary, i.e. potentially the retailer or the health organization. Yeah. So it can be a little complicated, but being specific in your marketing, obviously there's a bit of a game here as well, which is how can you best express your traction? Yeah. What data have you got, and how can you choose that data carefully to make the best impression? So some of it is presentational, but the core message here is, unless you can demonstrate to the relatively high standards of an investor that you've got to a point which is at least as good as it should be relative to your stage of maturity, of proving the need for what you're selling, then you're going to struggle.
Sure.
So that's the general point.
Yeah. Wonderful. Thank you. I won't hog this for the time being then, if there are other questions.
Okay. Thank you, Simon. Thank you, Richard, for those responses. I'm just scrolling through the chat to pick out the questions in the order that they were asked, and also to make comments about other things that people said. So just to pick up on the two questions that Simon asked, John Bradley and Daryl Bannon both made comments on that, which I'm going to make sure I have a copy of the comments in the chat, which I will also share with everybody later on. So if you don't feel like sort of having a look at that now, then you'll see those later on. And then another question was that, is there any weighting in the factors that you talked about, Richard, in particular things like team, traction and market? Is anything more important than, you know, is there a hierarchy of importance?
So so our process looks at a whole range of different criteria, and so we get multiple data points that ultimately turn into a single rating score. But each of those data points is weighted differently, potentially through various different levels. So you may have seen from one of the earlier slides, there are 4 key categories that each are scored, and various different data points may be relevant to more than one of those 4 categories. So there is a multi-level process of defining what the ultimate score is. And that's important, and we keep it secret, by the way, or private, I guess is better than secret. To your other question, Simon.
Yeah.
In order that it is less easy to game. Because if everybody knew exactly how we ended up creating our score, it might be a little easier for founders to create the perfect business to get the perfect score. So it's meant to be somewhat difficult to figure out. So we report on 24 fields within those 4 categories when we provide feedback to the startup, that those 24 categories that we report back on are not the data points that we capture and consider. So there's an asymmetry in the data that we collect and the data that we present intentionally.
Okay, well that deals with another question that's in the list. There's a comment from Daryl which I guess invites a question. How does intellectual property factor into the rating algorithm?
So it's we've got somebody on this call who is a particular expert in that field, Ian. So we've had this debate with Ian and some of his colleagues historically on how do you value or evaluate IP. So Ian knows very well how to evaluate IP and to value IP. From our perspective, it really comes into this question that we described about differentiation and uniqueness and the ability to sustain your business. Now, in some business cases, that will be because of formal IP that is registered. So you've got a patent, and that patent gives you the ability to operate for a certain period of time with a relative absence of competition potentially. But there are lots of other businesses that have different forms of IP, which might just be know-how or expertise or customer contacts, which is more difficult to protect, more difficult to evaluate, but not necessarily any less relevant to the sustainability of your business. So we have to take a fairly broad approach, and we're definitely not saying if you don't have patents, then you're not a sustainable business. But at the same time, we're not saying just because you've got a patent means you are a sustainable business. So we do take a fairly balanced approach to it.
Okay, thank you very much. Next one, Sue asks, what percentage of funding should go on business services, e.g. IP, legal contracts, marketing? And what are the best routes for securing funding for these?
These are, of course, all the things that investors really hate to pay for, apart from marketing. So all of that admin stuff, that doesn't help the business move forward, is the argument. So there's this really delicate balance between making sure that your processes and your governance structures and everything else is in great shape, and at the same time making sure that you're not spending too much money on it. And it's a really difficult one. This is one I've struggled with personally in the various different businesses I've been involved with, because often you can run up against a problem which means that you need to spend quite a lot with lawyers, for example, or with accountants. And the number of times that I've sort of hacked my way through a contract because I didn't want to or couldn't spend the money on a lawyer, false economies. So really important to get the governance and processes in good shape, but investors don't like to spend on it. And actually, plenty of founders and startups think that there are better things to spend money on as well. Marketing is an easier one to answer, even though it's obviously quite specific again to the type of business. So there are businesses where you can kind of say, okay, well, it's pretty obvious that you ought to be spending 15% of your revenues, of your projected revenues, on marketing. There are other businesses where it's, well, I understand there's a direct relationship between my marketing expenditure and my revenues, because I can calculate my cost of acquisition, and I can calculate the routes through which I'm spending on that marketing, and I know what the outcomes are going to be. So the more money I spend on marketing, the quicker I grow my revenues. And that then becomes a different story about the rate of growth. You know, if I had £1 million to spend on marketing right now, I would be able to grow my business very rapidly. Unfortunately, I've got £2.50, so my rate of growth is going to be slightly different. So marketing, key driver of growth. Every investor is happy to spend appropriately on marketing. What tends to happen, though, in the worst cases, social media, meaning what exactly? Because you know, you should probably have a slightly more detailed view if that is a significant part of your expenditure plans. IP, very situational specific again. That's about the importance of and the nature of the type of IP that you're looking to protect, and the rest of this is largely down to scratching and scraping around to make sure that you can present yourself in the best possible way as a business that knows what's going on properly, that has a good handle on its finances, that understands its legal situation, that has done stuff properly. Difficult one.
Thank you for that, Richard. Daryl's comment was that lots of companies don't actually have the money to pay for getting financial models. So I guess that can be rolled up into your previous answer.
Yeah, well, there's an additional point I'd just like to make on that, which I think is absolutely right. And it's one of those things which is, you know, why would you expect a startup founder to be an Excel wizard? Why would that be part of the job description for a founder? I mean, founders do lots of things, but complex Excel modeling is not necessarily one of the things that should be expected. So what do? You go and find somebody to build a model for you. Two problems. One is that that person's costs money that you probably don't have. And two is that they are removed from the business. So they don't necessarily have the feel for the business that's necessary to put together a really compelling financial model. So the sneak peek of what we're trying to do here is we're looking to use advanced voice recognition and natural language processing to capture in almost a conversation the data that's necessary to build a financial model, and to automate the process of the inputs of data so that as a founder, you can be an expert in your business and describe trends and what's likely to happen in terms of all the various different revenue and cost items. But the creation of the ultimate financial model is done for you. And that would be on a subscription basis rather than that'll cost you £5,000.
Okay, well, that was unexpectedly fruitful, given that it wasn't a question necessarily. Okay, Sue follows up by saying, what are the best routes for securing funding for feasibility studies to research the market need? And is this something for friends and families? And I'm not quite sure whether she means by grants that to try and seek money to pay for those feasibility studies.
Yes, and I think you've answered your own question, Sue, to some extent. And one of the very interesting things that happens over the last couple of months is that I think people have woken up to grants. So there was that first grant that was set up in response to COVID by Innovate UK, and they had like 8,000 applications, which is 10 times more than they've ever had before. And they only had a very limited amount of money, and less than 10% of the people that applied actually got anything out of it. So it's a bit of a lottery, and it's a significant time sink. We've done 3 grant applications so far this year for feasibility studies, for example, for the financial modeling tool, or for further automation of our rating system. 2 have already been unsuccessful, largely because of volume of applicants, we think. I would say that, wouldn't I? Because obviously our application was brilliant. So it is a lottery, and it is a big time sink. And it's kind of in some ways a bit like applying for investment. You need to know the rules, and you need to follow the instructions very, very carefully. But otherwise, given that that feasibility study tends to be I am looking to prove something which might or might not determine how much of a success my business could be in the future. That, if you think back to the risk-reward balance, that is more to be internally generated or grant funded. Yes.
Thank you. Well, given that we had a few problems at the beginning, hopefully people can stay on the call for say 5 minutes or so, because we've got a few more questions to go. I want to make a question out of what Simon asked, said about things being flexible. How do you see mentoring fitting in with what Capital Pilot has to offer?
So we are resolutely about scale. So as I said at the very beginning, so at least 3 of the people who are on the phone now, actually on the call now, actually heard it. But just to repeat, one of the key issues and problems in the early stage investment process is scalability. So you've got small teams at VCs or individual angel investors who don't have the access to resource to be able to do lots and lots and lots of investing. So it's all under scale, and certainly under scale in terms of the appropriate risk mitigation from diversifying your portfolio. We're completely about scale, so it's all as automated as possible, and therefore one of the things that we don't get involved in as Capital Pilot is mentoring. And so there's a natural match for us in dealing with a mentoring organization, which is to say, here's a company, they've had their rating and assessment report, it's identified some areas for improvement. Now let's hand that business over to a mentoring organization that can help that business to respond to and to take on board the feedback.
Which
so,
of course, yeah. So there's some synergy between what you're doing and what Founders and Mentors is doing as a place where people can get mentoring. That's terrific.
Completely,
okay.
And that's it's a core focus of ours to sell our services, not direct to startups always, but via organizations, accelerators, incubators, publicly funded bodies who are helping lots of startups, so that we can provide them with information that helps them to do an even better job for the companies that they are assisting through their programs.
Okay, brilliant. Sue comes back again saying, is there a smart way of evaluating investors earlier in the process to make sure they're on the same page with values and aspirations?
I've got an easy answer for the first half of that question, but the second half of the question becomes a little bit more tricky. So so the setting up of a process to identify what the criteria are for a good match with an investor is important, and that's really a data search. So what sorts of investors are relevant initially to a business at my stage of development? Am I really only looking for angel investors, or are there some VCs that might be interested? Are there some very early stage EIS funds, for example, that might be relevant to me? Is there a family office? Is there a corporate? So whatever is relevant to your business in its sector at its stage of development. And then obviously qualifying in or out that list of investors, because you then find out that this particular investor only invests in companies based in Yorkshire, and that one only invests in companies that are in life sciences or whatever else. So the first piece is a data exercise to make sure that you're targeting appropriately based on geography, sector, stage of development, and various other factors. The next piece about sort of fit from a more human perspective is really tricky. And that really can only be achieved either through some form of prior experience, which might be the fact that you're referred to that investor by one of their portfolio companies, or that you've got some other ability to connect prior. But I think 2 recommendations that I'd have. First is, it's never actually, this goes completely at variance with what I've been saying all through my presentation today. It's never actually too early to have a few chats with potential investors. Not the I'm looking to raise money chat, but the just thought it would be worthwhile reaching out to you to tell you what I'm doing and to ask if you have any views on my business proposition. So having open chats with potential investors way before you're looking to fundraise from them, actually the investors quite like, because you're not there with your hand out saying, give me money. So they're quite good conversations to have. And the second, which I alluded to just now, is look through the portfolios of potential target investors and reach out through LinkedIn or wherever else to the founders of businesses in which that investor has already invested, because you do get really useful information from those sources. There's a new business being set up, and I've forgotten what it's called, it's on the tip of my tongue, which is like Glassdoor for VCs. So it's an organization that's basically capturing feedback on the behavior of VCs, so that founders can get a bit more insight into what's good, what's bad, and what's downright ugly. And typically, I've forgotten the name of that. And it's a very, very new business. It's only been set up about 2 months. But I will. Well,
if you remember it later on, Richard, maybe you can email it to me and I can include it in my email to people.
Will do.
Okay, so I've also put Richard's details in there so that you didn't have to take a screenshot of the last slide, and those will be on the notes that I send through to everybody. Sue just simply asked, what's the cost of an initial audit?
So we charge £150 unless we like you very much, in which case you might be able to persuade us to do it for £100, but that's normally for organisations, and that's the full 24-page report and also the investor matching that we do after that, and so that's the package. Okay,
brilliant, short and sweet.
Very good value.
Well, yes, I mean, considering some of the comments that have been Daryl in particular has made in the chat, that's quite interesting. Again, from Daryl, just summarising quite a long comment. How do you see COVID lockdown having sort of impacted some of the proposals that you see, Richard?
We when lockdown first happened, we created a dual rating so that we looked at investability of businesses in normal market conditions, and now a completely meaningless phrase, and in current market conditions post-lockdown. So for example, the travel tech business that we had given a very high rating to a year ago would have got a very low second rating, because travel tech businesses largely at that time post-lockdown were not likely to be generating much investor interest for the foreseeable future. We've reverted to a single rating now. 2 or 3 things are going on as a result of COVID. First, I think, is a slight, and this is talking about now, a slight sense of false dawn. There are quite a few organizations that are desperately trying to pump out data suggesting that investment levels have not actually gone down very much. That's not our view. We see there's been a very significant reduction in early stage investor interest, particularly within the EIS investor framework. And many of the EIS funds are down about 50% in terms of their investment volumes this year. Not across the board, but it's again sort of a game of chance, so the potential for raising funding is decreased to the extent that your market is decreased. The other key thing, I think, is I'm a little bit of a pessimist, I suppose, in terms of the economic effects of what has happened. It's going to take a very long time for the real economic impact of COVID to unwind, and we're only just now seeing government support unwinding. There's some government support that's being announced recently, the Kickstart program, for example, very relevant to startups just now. But I think the outlook is a bit dodgy, frankly, for many startups. And that means that it's going to be more difficult to raise funding. And this goes back to my initial comment about the fact that the existing market for raising early stage money is really not fit for purpose because it's so clunky and low scale. And we desperately need, as a nation, to come up with new ways to deploy capital efficiently, not relying on public sources all the time, but identifying new ways to deploy capital efficiently from private sources that meet investors' and investees' needs, getting more realistic about valuations, but making sure that this entire generation of entrepreneurs that's at threat at the moment from COVID is able to persist. It's a massively important thing and something that we're quite focused on.
Well, that's very interesting. Given, I mean, I see Simon was going to come in. I was going to make the same point, really, that it kind of proves the need for what for the rationale behind founders and mentors, in that we want to try and get market fit validation for things before to get, to try and get investment into pre-launch startups. So I guess, Simon, that's the point you'd want to make.
Yeah, it was, and I'm also saying we better sort of wrap up here. But I wanted to, Richard, first of all, thank you so much. That's been incredibly informative and spot on for what we were looking for our sort of founders and mentors group. And I think Chris will post the video sort of ASAP so that we can get it to the people that missed. I love the fact that your audit is affordable for many of the founders that we're looking at. At £150, it'll stretch many of them, but it's not the sort of £7,500 thing that that would stop most in their tracks from doing this. I've got a few that I'd like to recommend going through the audit. What does it entail other than spending £150? What will they need to prepare? To get the maximum value out of it? What do they need to supply with and think about and prepare?
Okay, so first thing to say is if anybody comes through 12 Ronnies to request a rating, we will reduce the price to £100.
Brilliant, love that already.
And the way we'll do that is we'll provide you with an access code. Yeah. So I'm not going to do it. And you also get the free cucumber slicer, and you get the free juicer as well alongside it. No, not quite that, but we'll do that because that's what we typically do through organizations as a thing. So I'm delighted to be able to do that. What you need, and this is again sort of back to this point of where are you in the process, you need a presentation, an investor-focused presentation, and a financial forecasting model that goes out at least 3 years with a bit of detail in as to how your business is going to scale. So those are the two things. And in terms of the process, you go to our platform with the code that you've got via 12 Ronnies, and you then go through a short onboarding, which asks about 25 questions about your business, sector, stage of maturity, location, etc. And then you leave it with us, having uploaded your presentation and your financial model, and we get to work and get back to you in about a week.
Brilliant. That sounds wonderful. Actually, there's a few I got in mind, and thank you for the reduction in price for people going through 12 Ronnies and the Founders and Mentors platform. So,
very good. I'll send you the code so people have got that code, and then they can obviously approach you if they'd like to do that.
Well, in terms of wrapping up, what I'd like to do, because I know that we have within the call and also within the membership of Founders and Mentors, we have a lot of inventors, and we also have a lot of creative people who we take a kind of broad view that a pre-launch startup might actually be somebody that's writing a book or maybe publishing a magazine, or So I will follow up with you, Richard, via email to come up with some written answers about how the pilot could be useful for inventors and for creatives independently, because I am conscious that we're running out of time. As we're wrapping up, if everybody on the call could just write something very brief in the chat about your experience of today's webinar. We're not going to send a survey. We just thought we'd like to capture something of your feeling of today's event. Obviously, we've had problems with the technology, so that's a given, and we will explore alternatives going forward. But it would be really good to get a flavour of what you think went well, what didn't perhaps go so well, what you think about the topic and other topics that that you might want to see. And as we're wrapping up, before you leave, then it would be it just leaves me to thank everybody for coming, and especially to Richard for a very insightful and clear presentation, and a very sort of exciting opportunity for people, I guess, as they're moving forward. And hopefully, you know, we can look forward with founders and mentors to an interesting and collaborative relationship with what you're doing. So, Simon, is there anything you'd like to say in closing, or would you just?
No, I think no. Thank you very much, Richard. Spot on. And we'll upload the video, and I'll be in contact about people that I'm going to recommend through to you.
Yes, I'll be sharing the video and the chat notes, and you know, to everybody who's on this call and to everybody that booked a place, because as I've said several times, it wasn't anyone's fault why those people couldn't come. So just to say you know, to finish, just to thank you once again, and when you put your comment in the chat, then please, you know, feel free to leave the meeting, and then and we'll close off when everybody's said something in the chat.
Okay, bye guys.
Okay, bye-bye.
Bye now.